Iran reportedly threatening now to respond to any upcoming Israeli strike on its oil facilities with strikes on Gulf oil assets. And I want your reaction to this. Analysts say this could be retaliation for any help that these Gulf countries might give Israel in attacking Iran, or just as arbitrary punishment to inflict pressure or leverage over the global economy. So, first of all, is this a likely scenario in your view? This is Iran striking Gulf oil assets. And if it did eventuate, what impact could it have on prices and the market?
Well, I think markets are trying to price in some of these worst case scenarios. The threat that you could have a regional war spilling over and targeting critical global energy infrastructure, whether it's production assets or shipping routes, would clearly be, I think, quite inflammatory for prices. However, at the moment, markets are pricing in enormous amounts of uncertainties. And so that's why we're getting this elevated geopolitical premium. And it's acting like an insurance premium. There are many risks. We don't know how they will develop, how they will materialize over the coming weeks and coming months. But for right now, the sort of best course of action is for prices to go higher to try and put a price on capturing that risk that there could be disruptions to supply.
Indeed. So walk me through where you expect Brent and WTI to average as we head into the end of the year and the start of 2025. As you say, market investors seeking to price this escalating risk that we see in the region of a wider conflict here, but at the same time, also navigating the supply and demand side here, both which show somewhat of a bear case right now.
Yeah, as we stand right now, even with the the bilateral attacks that we have seen, the fundamental picture for the oil market has really been unchanged in the last couple of weeks. And as you say, it does tilt toward the bearish side. So for Brent markets, we probably think the kind of range we're in right now, say $75 to $78 a barrel, that probably might be about fair for prices for the final months of the year. WTI a couple of dollars below that. When we go into 2025, however, I think the fundamental picture starts to worsen as supply growth is going to be quite elevated if we do get those decisions from the OPEC plus countries to indeed increase their production from December onward. Now, we're not expecting that it's all going to come in one fell swoop, that, for instance, Saudi Arabia would try and return 1.5 million barrels a day that is taken out of the market in December on its own, but that it will be phased in over the course of 2025. But even at that kind of a gradual pace, going against the kind of soft demand growth expectation that we and I think many market observers have for 2025, we're still probably going to end up in a surplus oil market, provided the fundamentals as we see them right now remain intact. And so with that combination of factors, we think that the trajectory for prices into next year is for them to be going lower.